The stock market is closed right now, so we are looking at the final numbers from Friday's session on May 15, 2026. SMX Security Matters plc closed at exactly $9.15 per share, experiencing a slight decline of about 1.39% during regular trading hours, after bouncing around a day high of $9.26 and a low of $9.10. Now, if you look at that $9 price tag, you might think this is just another stable, small-cap tech stock floating under the radar. But here is the massive disconnect that the broader market completely misses, and it is an absolute wild reality for anyone looking at self-investing or looking for online investment opportunities. Just a few days ago, this stock underwent a massive 20-to-1 reverse stock split to maintain its listing compliance on the Nasdaq. If you look at its historical chart, its 52-week high is adjusted to an astronomical $356,808 per share, while its recent bottom brushed against $7.70. This staggering gap highlights a structural tension between what everyday retail traders see on a basic stock tracker versus the underlying survival mechanics playing out behind the scenes. When people open their Robinhood app or log into their Interactive Brokers account, they see a single-digit technology stock, completely unaware that they are looking at a business that has experienced a total structural wipeout in market equity over the last 12 months, shrinking its total market capitalization down to a microcap level of just over $3 million. The general belief surrounding SMX Security Matters is that it represents an advanced niche microcap play on supply chain transparency, a company with highly specialized intellectual property that just needs one major commercial contract to send the share price soaring back up. Investors using platforms like SoFi Invest or checking out various investing sites often assume that because the company deals with high-tech physical tracing, it holds an invisible floor of value based on its tech patents. The reality, however, challenges this belief entirely. The core tension lies in the extreme cash burn and the relentless dilution required to keep the lights on, which completely overpowers the theoretical value of the company's tech stack. Just hours ago, the company filed an official report showing they amended their 2022 equity incentive plan to dramatically increase their authorized share pool from around 237,730 shares to over 696,105 shares, while simultaneously handing out massive bundles of restricted stock units to executives. For anyone evaluating this through a long-term investment lens, this tells a completely different story than the bullish tech narrative. It shows a company aggressively expanding its share supply to compensate insiders and maintain operations, right after executing a reverse split to artificially prop up the stock price above the Nasdaq minimum requirement. Let us look closely at the recent trading activity, daily swings, and institutional volume to understand how this stock actually moves in the current market environment. Trading volume for SMX has been highly unusual over the past week, driven almost entirely by automated algorithms and high-frequency retail churn rather than long-term institutional accumulation. When you check data on institutional tracking platforms or a comprehensive individual brokerage account, you find that the typical holding time for this stock is an incredibly brief 4 days. This is not a stock that institutions are buying to hold in a diversified portfolio alongside stability anchors like Apple stock or Tesla stock. Instead, it has become a playground for day traders and momentum scalpers who utilize high-leverage platforms like the Interactive Brokers trading platform or the Robinhood trading platform to catch rapid microswings. The intraday volatility is massive, frequently exhibiting wild spreads between the bid and ask prices because the actual float of available shares is incredibly tight following the reverse split. When retail investors seek out online investing advice or investment help to find deeply undervalued assets, a price-to-book ratio of 0.38 might look like a screaming bargain on paper. However, the operational metrics reveal massive underlying financial distress, featuring a deeply negative return on equity and a negative return on assets that practically fall off the chart. This extreme structural volatility is exactly why major financial institutions and conservative wealth advisors keep their distance. If you look at major wealth management ecosystems such as Fidelity Investments or Schwab Intelligent Portfolios, you will not find automated robo-advisors allocating capital into microcaps like SMX. An automated intelligent portfolio is designed to seek out liquid, highly stable assets like broad market index funds, Fidelity ETFs, or diversified Fidelity mutual funds to manage risk for everyday investors. A hyper-volatile stock that can drop over 30% in a single day post-split is the exact opposite of what safe managed capital looks like. Even for individuals who prefer self-investing through a standard Fidelity brokerage account or the comprehensive Fidelity mobile app, managing a position in SMX requires constant minute-by-minute monitoring. The macroeconomic pressures of 2026, characterized by sticky operational costs and a highly competitive corporate tech environment, mean that small-scale technology firms without massive revenue streams face a steep uphill battle just to survive. Institutional ownership in SMX is practically non-existent, leaving the price action entirely at the mercy of speculative retail momentum and sudden corporate filings that dilute the equity further. To fully understand how SMX ended up in this volatile position, we have to look at what the underlying company actually does and how its business model is structured. Based in Dublin, Ireland, SMX Security Matters specializes in brand protection, authentication, and track and trace technology for the global anti-counterfeit market. Their core offering revolves around a proprietary chemical-based invisible marker system that can be permanently embedded into solid, liquid, or gaseous materials without altering their physical properties. Think of it as creating a permanent physical barcode inside raw gold, silver, plastics, or luxury textiles. This chemical marker is then read by a proprietary electronic reader, which links the physical material directly to a blockchain digital platform, creating an unalterable digital twin of the product from raw material to final sale. On paper, this business model sounds incredibly robust, especially in an era where global supply chains are facing massive regulatory pressures to prove ethical sourcing, track carbon footprints, and eliminate counterfeit goods in luxury markets. The company has tried to position its tech across multiple high-value verticals, showcasing applications in the oil and gas sectors for real-time fuel authentication, as well as partnering with fashion sustainability initiatives to track textile recycling. Yet, despite this highly sophisticated technology, the historical financial reports reveal a steep disconnect between technical capability and commercial monetization. For years, the company has struggled to convert its pilot programs and high-profile memorandum of understanding agreements into predictable, recurring commercial revenue. When you dive into older financial statements accessible through a Fidelity Wealth Management review or Interactive Brokers fees disclosures, the revenue figures have historically remained incredibly small relative to the millions spent on research, development, and global marketing. This lack of financial runway has forced the management team into a continuous cycle of survival strategies. Over its history on the Nasdaq, the company has undergone multiple governance overhauls and repeated reverse stock splits just to keep its share price from falling into the pennies and triggering delisting procedures. This structural reality completely shatters the idealized expectation that innovative technology automatically translates into a winning investment. Without a scalable, profitable commercial engine, the underlying tech becomes secondary to the ongoing corporate battle against cash exhaustion. Comment below how many shares of SMX Security Matters PLC you currently hold, or if you are completely avoiding this stock in the current market environment. Looking forward into the future outlook, there are two distinct, highly contrasting scenarios that could play out for SMX, both deeply tied to this tension between market expectation and operational reality. In the optimistic best-case scenario, the massive global push for supply chain transparency could land SMX a definitive multi-million-dollar commercial contract with a sovereign government or a massive global luxury conglomerate. If a massive industry leader integrates their molecular marking technology as a mandatory standard for tracking raw materials, the company's revenue profile could change overnight. Because the post-split share float is exceptionally small, any genuine positive fundamental catalyst could trigger an explosive short squeeze or an intense momentum rally, causing the stock to skyrocket on retail apps like Robinhood or SoFi Invest. For speculative traders utilizing advanced tools like the Interactive Brokers platform, this high upside optionality is the primary reason SMX remains on their watch list, despite the obvious operational dangers. Conversely, the far more probable downside scenario involves continued commercial stagnation and further structural dilution. If the company cannot rapidly secure self-sustaining cash flows from its current operations, the newly expanded authorized share pool will be utilized to raise capital, dilute current shareholders, and fund executive compensation packages. Management has already explicitly signaled to the market that additional reverse stock splits remain a distinct possibility if the stock price faces a new downward pressure. This continuous cycle of reverse splits followed by equity dilution acts as a structural downward escalator for long-term retail investors who buy in hoping for a bottom. While mega-cap tech giants like Nvidia stock continue to draw massive capital inflows across all major investing sites due to undeniable profitability, micro-cap experimental tech stocks like SMX are operating in a completely different risk universe where the threat of total capital loss is a very real factor. When we synthesize the core insights of this analysis, the contrast between expectation and reality becomes completely clear. The expectation surrounding SMX Security Matters is that it is a highly innovative, deeply undervalued technology company offering a cutting-edge solution for global supply chain verification, making it look like an attractive high-reward gamble for an independent individual brokerage account. The reality, however, is that SMX is an ultra-high-risk microcap vehicle currently locked in a brutal structural battle for survival, marked by extreme insider equity expansion, a history of heavy dilution, and a total reliance on speculative retail trading volume to maintain liquidity. For the smart investor reviewing their self-directed strategies, this analysis serves as a stark reminder that unique, high-tech intellectual property means absolutely nothing if the corporate architecture cannot protect shareholder value from being systematically eroded.